Hi Carol, this is Riddhi with Prospect Mortgage. This is the spreadsheet that I was talking to you about, you comparing owning versus renting a property. So what I've done is, based on our conversation, I've assumed that you have a purchase price of around 250,000, and if you were to rent a similar property, your rent is going to be around $1,800 per month on that. And we're going to assume that the rent is going to be increased by 2% every year, which is actually a very small number. Usually, even if you were to stay in the same property, the rents usually tend to go up by 5% every year. So let me give you an example. On a $2,000 property, your rent, if it was to increase by 5%, it will go up $100 every year. So on $1,800 will go up by $90 every year. I'm just assuming 2%, which is a lot less. On the homeowner's side, I'm going to assume that your property is not going to appreciate at all in the next 12 to 36 months, which is not the real right thing to do. But I'm looking at the worst case scenario because everybody is concerned that they keep thinking what happens if the property values go down even further. So I'm going to assume, since we are not selling it in next 36 months, we're going to assume our property is not increasing in value. And let's compare it to renting and see which one comes out ahead. I'm also making a couple other assumptions on basis of your clients. So the first assumption was we are going to do a purchase price of 250,000. We are going to do an FHA loan, which is a 30-year fixed loan with the lowest possible down payment, which is 3.5%, and we can get a 5% rate today. Actually, we can do a lot better than 5%, but I'm gonna again take worst case scenario. We don't have a property identified, so in case the rates moved up, I'm gonna assume they're at 5%. There are no points, no prepayment penalty, and we are also going to assume they're in a 20% tax bracket, which is pretty low. A person buying 250,000 homes usually is in a higher bracket, but I'm gonna again assume it's only 20% tax bracket. The down payment is 3.5%, which comes to 8,750. The closing costs look really daunting, 4,913, but it is made up of two things. One is FHA charges 1% upfront insurance, and I'm going to add that into the closing costs, plus another $2,500 for your closing costs, which will be ample on an FHA loan. So out of that 4,913, the $2,412, which is 1% of the loan amount of 96.5% of 250,000 value, can be rolled into the loan amount. So we need cash to close is around 11,250. FHA is a really generous product in the sense that you don't have to have that money of your own. It can actually be a gift from a family member. So there are several ways. We can come back and talk about it if there is a concern as to how we are going to get that cash. So let's leave that. Let me show you how the payments compare. So the left side of the column is the rent, and the right hand side of the column is ownership. So we are looking at the 12 months analysis, meaning if we were to rent the property for 1 year. So 1 year, if we are, a rent for a month was $1,800, in 1 year we would have paid a rent, altogether rent for the entire year, in an amount of $21,600, which is a really large amount. But keep that in mind, if we were to own the property, we would have paid 24,852. Let me show you how we come to that. So here is the breakdown of the payments. On a rent, 1,800 is all we pay. We are not responsible for taxes or insurance or anything like that. So I'm just going to leave it 1,800. If we were to own the property of 250 with 3.5% down, our principal and interest payment will be 1,308. Our taxes, insurance, and other. These things are your real estate taxes. I'm assuming 2.25%, which is a very realistic number for our areas. Your homeowner's insurance, I'm assuming $60 every month, and I'm also including PMI in that because in FHA, PMI is added to every loan that does not have 20%. So altogether, that comes to $763. There is nothing that's remaining outside of these two numbers. So if we were to add, this is the out-of-pocket cost we'll have, except for utilities that we haven't counted, which you'll have on a rental property too. So we're comparing apples to apples. So our rent will be 1,800. Our total payment will be $2,071. Okay. This also gives us a couple other numbers. One is a tax benefit. Remember, I mentioned I'm going to assume your clients are in a tax bracket of 20%. So every month, since we are paying $1,308 plus $763 in taxes, etc., we will get a tax benefit every month of around $297 back to us from the government, because we are paying that. There's a mortgage interest deduction that you will be able to claim, and you'll be doing an itemized tax deductions. And remember, when you buy a property, you every month when you make the payment for principal and interest of 1,308, part of the payment goes towards your principal reduction because it's a loan. So out of $1,308, 293 will go towards reducing your loan amount. That's how you get paid up in 30 years. So now let's come back to this column. So this was the rent column. We would have paid $21,600. For the house, we would have paid $24,852. But now we have some other credits coming back to us. We would have paid, out of $24,852 that we paid to the bank, $3,595 would have gone towards reducing our loan amount in the first 12 months alone. So if we start with a loan amount of $241,000, our loan amount $35,995 will be going towards our principal reduction. We will also get, in addition to principal reduction, remember we talked about getting the tax benefit, we will also get a tax benefit of $3,546. That's just 12 times 293. So that's what we will get. So net cost after we reduce the loan and get the tax benefit, our total cost will be only $17,712, because the principal paid is actually you're accumulating money. It's like a forced savings, so that's why we are reducing it. Now, since we said our real estate is not going to appreciate, we're going to keep it at 250. Our loan balance is 240,068. We start with the higher amount, we deduct that 3595 from it, come to 240,068. So now our total equity goes up to 9,932. Starting, we had started with 8,750. We go up to 9,932. Now we are going to the 36 months. So let's say we were to rent the same property for 3 years. How would the whole numbers outlook look? So in rent, we would have paid $66,105. Again, there is no other benefit to us. There is no loan reduction since there is no loan and there is no tax benefit. So it would actually cost us in our pocket $66,105. The total payment for home ownership based on that $2,000 or so payment, it would come to $74,557. We would have paid a principal of $11,346, and our tax benefit would have been $10,525. So our total cost will be $52,686. And remember how we got to these numbers. We have a benefit of $293 for the loan reduction. And keep in mind, every month when we are making the payments, mortgages are simple interest products. What that means in plain English is that every month when we make a payment, even though our payments stay the same, more money goes towards the principal and less towards the interest. It's a sliding scale. That's how we come down. If we were to keep that loan for 30 years, our loan balance would be zero, because little by little our loan is getting lower, even though loan amount is getting lower, and we are paying more and more towards our principal even though our payment stays the same. Okay, so that's how we get to that number. Again, the real estate value wouldn't have changed because we are making an assumption that property values are not going to go up. Our loan balance would have gone down to 232,317, and our total equity, the difference between 250,000 price value and the balance, is 17,683. Now this overall thing is the total investment in 12 months. Remember, we paid something towards our closing costs, and we put some money towards down payment. So what I did was, just to illustrate the example, the down payment that we had, 8,750, we put it up in a bank account, let's say, and we were generating 5%, which I know is unheard of in this market, but I just assume, let's assume we're going to um, earn a 5% interest on that. So in 12 months, that 8,750 would become 9,198. Total investment in 36 months will become 10,163. So now we will have 10,163, whereas our total net worth because of the property increase, the loan amount that got reduced becomes $17,683, and I haven't even counted the tax benefit. So your home's equity is this much. Your asset account has zero because we use the money for the down payment. Our total net worth will be 17,683. So in 3 years, if we reduce the 10,000 that we left in our investment account from 17,000, after 36 months you will be $7,520 wealthier as a homeowner, as well as you would have pride of ownership. So, and if the values were to rise again, even if they increase 1 or 2%, it would come out much higher, because remember, when the home prices increase, even if they increase by 1% on a $250,000 home, your home price would go up by $2,500. So it really accumulates. That's why home ownership has been such a great investment, unlike any other investment when it comes to your money and your assets. If you have any further questions, give me a call. I'll be happy to walk you through this. Good luck. I know there's a lot of noise in the media how it is not a great idea to buy a house. In my opinion, it still is a great idea to buy a house. The interest rates are at historical lows and the values have gone down so much that it really does make more sense to buy a house than to rent the same kind of property. Look forward to talking to you. My cell phone number is 630 660 6376. Give me a call. Thanks again. Bye bye.